stock market, suffering major losses on the heels of the president's tariffs.
Stocks are tumbling for the second day.
Millionaires are made when the stock market crashes, and the bigger the crash, bigger the opportunity. But you need to be greedy when others are fearful. So in this video, I will cover everything I know about this market crash, how Trump's tariffs will make millionaires, and which stocks could give you huge returns. First thing is first, I am not here to hold you hostage. Here's the full breakdown of this crash. No negotiations needed. The stock market recently experienced one of its most severe downturns in recent history, with major indices like the S&P 500 and Nasdaq plummeting due to escalating trade tensions. The latest round of tariffs has sent shockwaves through global markets, triggering a sell-off reminiscent of the early pandemic days. But while many investors panic, seasoned market participants recognize this as a rare opportunity because the biggest fortunes are often built during market crashes, not bull runs. The immediate cause of this sell-off is the unexpected severity of reciprocal tariffs imposed by the U.S. and its trading partners. For example, Chinese imports now face a staggering 34% tariff on top of existing duties, while European goods are hit with 20% tariffs, and Southeast Asian exports like textiles and electronics are subject to 46 to 49% tariffs. Given that China and the EU account for nearly 25% of all U.S. imports, these measures are disrupting supply chains, raising costs for businesses, and fueling investor uncertainty. Why these tariffs may not last, and what that means for investors. The current administration's trade strategy appears to follow a three-part plan. 1. Using tariffs as leverage to force trade renegotiations as seen with Canada and Mexico. 2. Implementing reciprocal tariffs to create economic pressure for fairer trade terms. 3. Weakening the U.S. dollar to boost exports without jeopardizing its reserve currency status. However, there's a critical flaw in this approach. The so-called reciprocal tariffs aren't truly reciprocal. Instead, they seem calculated based on trade deficits rather than actual foreign tariff rates. For instance, the U.S. trade deficit with China $295 billion was divided by total Chinese exports to the U.S. $439 billion, resulting in a 67% figure, which was then halved to set the 34% tariff rate. This arbitrary formula ignores existing trade dynamics and could provoke even harsher retaliatory measures, which is exactly what's happening now, with China announcing 34% tariffs on U.S. goods. Historical data reveals that bear markets, on average, last 11 months, with recoveries taking about 2 years. For example, the 1956 crash saw a 21% decline over 15 months, followed by an 11-month recovery. The 2020 pandemic crash was sharper 34% drop in a month, but rebounded faster 5 months to recover. The key takeaway? Market downturns create buying opportunities, but patience is crucial. Instead of trying to time the bottom, focus on high-quality assets that are undervalued due to panic selling. How to spot the best opportunities amid the chaos. To navigate this turbulence, smart investors rely on data-driven indicators rather than emotions. One useful tool is the CNN Fear and Greed Index, which currently signals extreme fear, a strong contrarian buy signal. This index aggregates market momentum S&P 500 versus its 125-day moving average. Volatility VIX measures expected price swings. Put/call ratio shows investor sentiment. When the VIX stabilizes after a spike and momentum starts trending upward, it's often a sign that the worst is over, and that's when strategic investors begin accumulating positions. Which stocks could benefit once the dust settles? 1. Tech giants Google and Meta. Google's P/E ratio of 18 is near a 10-year low, with DCF models suggesting 43% undervaluation potential, 77% upside. Meta's fair value is estimated at $880/share, implying 75% upside from current levels. 2. Semiconductors TSMC and NVIDIA. TSMC produces 90% of the world's advanced chips and is trading 33% below fair value due to tariff fears. NVIDIA's P/E of 32 is its lowest since 2019, presenting a long-term growth opportunity. 3. Diversified ETFs Nasdaq 100. The Nasdaq 100 tends to outperform in recoveries due to its concentration in resilient tech stocks. Final thoughts. Turning market fear into long-term gains. The best investors don't panic, they prepare. By focusing on fundamentals, historical trends, and contrarian indicators, you can capitalize on this downturn while others flee. Remember, bear markets don't last forever, recoveries always follow. The biggest gains go to those who buy when fear is highest. Diversification, including real estate or low correlation assets, helps mitigate risk. If you found this breakdown valuable, consider exploring more strategies to build wealth systematically, because the best investment you'll ever make is in your own knowledge and discipline.